We're going to tackle geopolitical risk and your money. Well, if you've looked at the news lately, you've probably seen words like war, oil spikes, tariffs, inflation, basically all the stuff that makes your portfolio want to hide under the basement stairs here. But there's a recent piece, guys, from Michael Kitz's blog, and I really like what they've done here because of the fact that this blog is made for OG advisors like you. It's addressed at advisors talking about how to help your clients get through the threat of geopolitical risk. And the big question in the piece, of course, is this different or is this just another chapter in this same story? So let's go through where we're at in the story lately. Markets had a strong 2025. We had this first pullback of 2026. Of course, OG, we've got headlines that drive fear, right? The conflict in Iran, oil spikes because of that, tariffs and policy uncertainty, inflation still feels sticky, markets react with some volatility.
Other than that, Mrs. Lincoln, how did you enjoy the play?
But it seems like we always have fairly high expectations, but because markets were so high in 2025 and have been so high fairly consistently the last several years.
23, 21.
Yeah, do you
19,
think number
18.
one is we parse through this? Do you think maybe it's time to reset our expectations to what the stock market really does in an average 10-year period just versus what we've had lately?
Well, I think it's always important to recognize a few facts around investing. The first thing is that volatility is totally normal. And volatility sounds like a scary word, so I'm going to just change it and say variability. And so if you think about the average return and say the S&P average is 10%, so I just put in 10% in my plan, that's fine. But we also know that the market rarely even lands within 2 percentage points of 10%. So it's rarely between 8 and 12. It's more extreme than that in terms of its variability. And what we find as investors is that we're really okay with variability that happens in our favor. But it's like, boy, I really like that variability when it's like plus 23. Those are really fun variability days. But the reality is that if you just think about this logically, if you had a plus 23 day and you know the average is 10, we got to have a 0 to offset the plus 23 to get back to average 10, right? Like that should intuitively make a little bit of sense. Now, the reality is that it doesn't work that linearly. It's not like, oh, this year was up 20, next year is going to be 0 to even it out. That's not how it works. But you can string together some data points and like you said, well, 15 of the last 17 years, the market's been positive. Can I take that and assume it's going to be negative? No, but it wouldn't surprise me if it does. The second thing that I would think about in terms of variability is what's normal in terms of the ups and downs within a calendar year. And so if you look at like performance data and say, okay, the market average is 10%, and I can go back and say, well, what did it do in 23 and 22 and 21 and so on and so forth. And I can draw this chart all the way back to the 1900s, early 1900s of reliable, what did the market do? You'll see it's all over the place. But then if you look into each year individually and say, well, yeah, 1966, the market was up, but what did it do in the year? It didn't just go boom, boom. There weren't 2 data points, Jan 1, December 31, right? There was 270 data points. And so what we find in the in-between time is that sometime during the year, on average, the market's down 14% from the high watermark of that year. So if I put those two things together, and that's the normal piece that, hey, over time, we're going to average 10. If we strung together a bunch of pluses, maybe we have a negative. That would sound reasonable. And in between the times, those data points of Jan 1 and December 31, we're going to experience a minus 14 normally. That's a normal year. When we see things like, oh my gosh, the market's down 7%, what do we do? That shouldn't even be on the radar screen yet.